Hi, this is Dan at Master Trader, and in this brief video, we're going to define what a covered call is. In our option strategy series, we divide the strategies taught into directional strategies and income producing strategies. Covered call is a directional bullish strategy. For a refresher, what is an option? It's a contract allowing for the right to buy or sell something during a specific time for an agreed upon price. People who buy call options, they pay money and they have the right to buy. That's bullish. Call sellers receive money and have the obligation to sell at the strike price. Now, in and of itself, that's a bearish strategy, but as you're going to see, we are overlaying this with buying the stock, but this money that we're receiving for this increases our probability of profit. So here's the definition of a covered call. You're buying stock and you're simultaneously shorting call options against it. And since one option represents 100 shares, you want to sell one contract for every 100 shares of stock. Your maximum gain is whatever you've agreed to sell the stock at, less your break even, which is your improved cost basis. So what is that break even? It's whatever you paid for the stock, then whatever you sold the call for, that reduces your cost basis. And so that's why your maximum gain is increased, it's enhanced, if you will, but you're capping your gain. The return on investment is whatever you make divided by the net margin on the total position, which if you're long stock, it's 2 to 1. So selling this call option, it lowers your cost of buying the stock and generates time decay income because this short call is a time depreciating asset. Covered call, again, a bullish strategy. We actually refer to it as a mildly bullish strategy because if you were fully bullish, then you would either buy the stock or buy a in-the-money call option, and we're shorting it out of the money call, which limits our potential upside, but again, we do it in exchange for lowering our cost basis and generating additional income. So it's a lower risk trade. Here's our quote screen on the ETF QQQs trading at 114.05. So the 114 is that strike price is at the money. So here's what you do in buying a covered call. You're buying the stock. It's not shown on this quote screen. These are just the options. Calls on the left, puts on the right. So you're buying the stock, let's say 1,000 shares. Then you pick your desired call strike price, which we obviously teach in our option strategy course, which strike to sell and how many days to expiration. This particular example is 15 days to expiration. So if we bought 1,000 shares of the QQQ, we would sell 10 call options against it, which are based on these prices are trading at $1.10 a share by $1.14. We always try to get filled at the midpoint, which is $1.12. So you're putting $1,120 in your pocket, which lowers the cost basis of this $114.05 a share. So that's it. That's a covered call. Hope that helped, and see you next time.